Hi everyone, I'm Bag of Don at Stock Market Caddy. It is June 19th at about 11 p.m. and we had Chairman Powell doing his dog and pony show with the Federal Reserve, and a lot of speculation tonight about what this means for the markets and where we're going, and that somehow or another the Federal Reserve has figured out the perpetual money-making machine of the markets, and we're never ever going to go down again. We're only going to go up because the Fed has a put on and they can do this and they can do that. Well, let me share with you something and then you tell me what you think. I'm not going to reach any conclusions. I'm going to leave it up to you. You're looking at a chart. The green line, this green line, is a weekly chart, line on close, of the S&P 500 going back 10 years, all the way to like 2009 when we started coming out of the abyss. This is down below 800. We're up here at some, 2,900, even a little bit further as we move this chart. This is the yield in comparison on the 10-year bond. So yields, when the market was very low and in trouble, yields were on a relative basis. The yields on the 10-year Treasury were much higher. Well, thanks to the Federal Reserve, they introduced quantitative easing, which nobody knew what it was. Now it's a conventional tool, and it's just a mechanism where they can lower interest rates. And they lower interest rates primarily on the short end of the curve, but they can impact the rest of the curve as well. So the real interest rate that we like to take a look at when we're assessing how healthy the overall market is what's going on with the yield on the 10-year in relation to the S&P. And what you saw was the yield coming down, and then you see the market headed up. And then let's just slide this across and let's see what you see. Okay, and so then you actually had a period of time here where yields began to rise and the market continued to go. So it wasn't, necessarily inversely correlated, right? You might even said it was kind of a positive correlation. And let's just keep going and you tell me what's happening. Okay, so yields on the 10-year were actually rising, and so wasn't the market. And then they kind of came. Look at, they're almost shadowing each other, right? And then yields start to drop a little bit. Market gets a little knee-jerk reaction, and what happens up here? Okay. Right here, yields really break. So in the beginning, there was this inverse correlation, and then once the market got going, the yields were kind of going up with the market going up. But right in here, there was something significant. The yields really broke down, and the market broke down, and then miraculously it stops, and then it runs up again. Then we have this shock, and then we had this other run-up today. We're going on in the last couple of weeks because the Fed said we're going to do what? We might do some more QE. And look at what's happening to the 10-year yield. Dropping like a stone. Now, you tell me, is the market just going to continue to run and run and run? Or is the yield dropping for a reason? Remember, he doesn't control necessarily the yield on the 10-year bond. And we did break here. Was it here that maybe they thought the yield was going to hold and everything was going to be okay? Because there is this diversion now, this significant breakdown in yields. Or does the market double top, triple top up here and run down to catch up with what the bond market is saying? I don't know. You tell me. Now let's park this because I don't want to make it too busy. And so we're going to zero that out. And the other market that's making a big move tonight and has been moving is gold. And so we're going to go in here and we're going to brighten that up so we can see it. We're going to go to the style. We're going to fatten this up. We're going to paint it yellow for gold. And we're going to close it. And there's gold. So let's kind of do the same thing. Is it negatively or positively correlated? So here we are coming out of '09. I could have left even, you could do the same thing with interest rates but one of the things was coming out of '09, there was this big rally in gold. Everybody kind of thought there was going to be inflation and maybe didn't think the market was going to make it. And this is where gold actually topped out. And you might say from this point on, this in here, and maybe it was manipulated, who knows, but for whatever reasons, gold started to go down. The people became less concerned, and the market took off on its own. And let's just slide and just kind of watch what happens. The market is going up, and gold is going down and basically sideways. So you'd say that they were negatively correlated here, and right here they're just not even correlated at all. They would be negatively correlated or just flat, meaning, gold is going down as the market is going up. And what have we got here? A significant move up and a breakout in gold. What's the market doing? Going up too. Do you think it's going to stay there? You think it's going to run with gold? Or is this market going to react here? The folks that are in the gold market are seeing something that's making them want to buy gold. And when over here, when people were selling gold, the market was going up. So are these buyers of gold indicating, are they smarter than these holders? Are they saying, hey folks, this thing's going to come down? Same thing that we just saw on the yield on the 10-year bond. The yield was moving with the market and was going higher, and the market was going higher. And then the yield broke and started going down. And the market, just like the cockpit of flight TWA 800, it kind of broke off, right, in that poor plane crash. And the momentum of the plane with the jet engines probably still running. God, can you imagine that? Oh, Jesus. And it just kept flying. It actually rose in altitude. Is that what the S&P is doing? You tell me.